What's up, Chris?
What's going on, Jay? Happy holidays.
Happy
I know,
holidays.
for all those e-commerce sellers out there, it's right in the middle of the busiest time of year, the most wonderful time of year, the time of year that makes you a seven-figure e-commerce brand, right?
That's right.
Um,
That and
and so,
it's the glorious time of the year, and it's the most stressful time of the year. And
no doubt about
and
that.
I kind of we're gonna hit on that stressful part
Yep,
because unless you timed it properly, the busiest month is also the end of your year.
that's right.
So there's some prep you got to do.
That's exactly right. Like, there's a bunch of things that you can do now because the year's not quite over.
Not quite.
And so when we talk about that, oftentimes what we're talking about really truly is tax planning, and that's stuff that you can start today. And so, what are those year-end tax moves that your now seven-figure business that you can start to make right now that actually matter? Well, there are a few different things that we want to highlight for you here. If the books are wrong at the end of the year, like you already got bigger problem. You got bigger fish to fry.
For sure.
If most business owners, this isn't true to just e-commerce, it's true to everywhere. Most business owners often focus on deductions, right? Like, you're like, how can I save on taxes? How can I save on taxes? Rather than the quality of your actual underlying numbers.
Yeah.
And to that point, like, clean data is the core of year-end tax planning, because if you have bad numbers, you're gonna have everything else isn't gonna work properly, right? So you're not
For sure.
you're not you're not just buying stuff to write it off. That's not the point. You're buying them with intention, and they also may be able to be written off, right? That is what true tax planning is really about, not just finding all your deductions.
So you hit on the key point here.
Yeah,
We're in December, but yes, we are in tax panic, but tax panic is self-induced because if we start looking at tax planning in June and July and August, we know what to expect when we get here. And
that's right.
that's what it's all about. Tax planning, tax planning, tax planning. So we're going to drive that point home for the next 3 weeks.
Yeah. Absolutely. An important point to note here, right? This isn't just a CPA checklist or some webinar it's a replay, right? We're intending to focus this specifically to brands and why, why these things matter to you as an e-commerce seller. So be aware uh, that's the stuff that we're talking about is things that you can do between now and the end of the year, and why they matter, how they help to position you better for quarter one, and all of that kind of stuff.
Yeah, and
Um,
you mentioned going out and buying things. So December is always that time, and you get that panic call on Christmas Eve. Hey, should I buy a car? I'm like, well, do you need one? Well, no, but I need a deduction. Well, don't buy a car. Buy this. And so
right.
there's a whole conversation about that because you have to
Yeah.
have a certain vehicle to depreciate the whole thing. And the thing about that is you might not need to spend $90,000 to get that deduction, and you might
That's right.
not be able to afford the $90,000 to get
That
that
may
deduction. So
We'll
you
talk a
got to
little
be
bit more about
smart.
that.
Yeah.
Yep.
So we'll get into all of that. So
Yeah, exactly. So, obviously, Jay alluded to this before. The end of the year can be really, really hard for e-commerce brands. You just spent like a bajillion dollars on ads. Your conversion rates, like, you're not really sure what you're expecting because 2 weeks ago they were awesome, and now they're like really lousy. But you know that they might pick up next year if you didn't quite have the Black Friday week that you were hoping for. Maybe your inventory is a little heavier than expected, or maybe alternatively you had a really, really successful one and you're looking at stockouts or other issues like that. Like, cash may feel tight even if the year has been just a smashing success. And that's true this time of year for everybody, because all of that inventory that you needed to get through Christmas time here, through the end of the year, you had to pay for that all in advance. And so you may have some holiday special that you still haven't slammed the last little bits through, but you had to pay that supplier. So um, you may end up in these situations where like everything feels like it's super tight, even though you may have had a really successful year.
Yeah, and
Um,
if this sounds really familiar to you, just know it's not you. Everybody's
yep,
feeling the same stress. And,
that's right.
the thing that Chris is talking about, it's like you have these great sales, but you now have products sitting in your warehouse. And that is your profit. It's sitting back there on the shelf. So you have a couple more weeks. This is the time to drop those prices and get them out. Convert that inventory to cash, because this is the time that really matters. You don't want to leave that stuff sitting in the warehouse, because this could
Yeah,
be your last chance to sell it,
yeah.
realistically.
And there are other things that cause cash constraints and other like especially hard things too, right? Especially if you're prepaying for ads. Like if you're paying for
Yeah.
ads a couple days in advance or something like that, you may be really tight on cash. And especially if you're selling a bunch of your inventory through Amazon, like you may not be getting those payouts for another week. So you may have had a
Yeah.
really successful Black Friday, but you may not even have that money yet, and that can be particularly challenging. And so what that results in is that your financial statements, your financial position, often lags the real operational truth. And so you don't know today, if you're looking at your finances necessarily, you don't know on December 9th exactly how you stand for the month of November, because you may still be having some things clear. You may have some stuff you've paid for already, that again that you're selling next week. And so the things that people often do, right, is maybe a clearance sell, which is driven by cash stress, not some of those things that we've talked about in prior episodes, where it's strategic clearance stuff, where we're taking your slow movers and getting them out of your warehouse. And if you're just driving those discounts by in order to collect cash, that's not strategy. That's just stressful cash management. And so those decisions that you may be making may be made without understanding for the margins or the tax impacts, right? You're just making them to make ends meet, as we talked about it through that whole cash flow cycle that we had of the 4 episodes talking through cash decision making, right? We're here to help to guide you to make better decisions. And so when we talk about that, that's what we're going to talk about next. They're the things that you can do now, in the face of all those pressures that we just talked about, before the end of the year, to make sure that everything is in good order, that your books and records are nice and clean, um, and that'll allow you to work with a tax professional and to ensure that you do have a good quality and productive tax planning and discussion. And so it's important because these things are like table stakes with respect to making sure that the tax planning is correct, right? When you have that clean data, right, like that's a mandatory thing that you need in order to be able to make the right decisions. Because again, if you've got a whole payout that you haven't recorded from Amazon from Black Friday and you're trying to make decisions on it, um, that may be a bit of revenue that you definitely should be recording, but that you haven't yet. And that can make you make a bad decision because you may think that you're not as profitable as you have been, or the opposite way, right? There could be all kinds of different impacts or factors that go into uh, those tax planning discussions. So, what should you do, right? We talk here always about actionable stuff, um, and that's what we're going to start with today. And so, the first action that you absolutely, absolutely, absolutely must take as we head into the end of the year is you need an inventory and cost of sales reality check. You need to know, are your inventory counts, the inventory that you say you have in Shopify, or the inventory that Amazon has on sale for you, are they real? Like, does that actually reflect reality, or are they wishful thinking, right? Oh, yeah, maybe we'll have some inventory over there, that kind of thing, right? Um, Jay, when you think about inventory management, especially in the end of the year like this, what are the things that come to mind for you?
Yeah, it's the existence. It's that audit thing that you used to do. It's what actually is in that inventory currently, and is what
Yep.
is out on the shelf in inventory. Is it not? Is it overstated, understated? Is it
Yep.
valued at the right price? Things like that. And what we've talked about for what I feel is like years now is slow moving goods. Things that
Oh yeah.
you need to obsolete, write off, get rid of. And that's what I was talking about earlier. You have these things in your warehouse. This might be your last opportunity to sell it. So, and I'm not saying that from a cash standpoint. That's a strategy standpoint. We don't want to leave it sitting in your warehouse. So get it out, sell it now. And, so now is the time to run those reports in your IMS and look at the days sales that you have for those items. And do you have something that's sitting there with 600 days of stock on hand? Well, it's time to look at that. Do you need to liquidate it? Do you need to move it somehow? Or are you sitting there with 20 days and you're paying purchase orders every 30 days for these products? And that's where having the data that helps you make these decisions is so necessary. And that's why, maybe your numbers are wrong at 12/31. Well, they can't be wrong at 12/31, because if they're wrong at 12/31, everything from that is going to be wrong, including all the analysis that you've done. So you're just setting yourself up for failure. And,
Absolutely.
The truth is, inventory truth is non-negotiable. You got to know what you got. You got to know what the value is. You got to know what it costs you. And when I say what it costs you, it comes down to what? What's that, Chris? Huh?
Our landed cost calculator?
The landed cost. Yes.
Yeah, that's right.
Yeah, so you want to make sure that you have the true landed cost that you're valued your products at. So, now's the time. Get it in there, understand it, and go into the new year with numbers that are true and are ready to go for 2026.
Yeah. And that's really important, because there are some spots where you can run into problems. It is an issue occasionally, a common issue for Shopify, Amazon, or your inventory management system integrations to accidentally inflate inventory. Like, they may just not relieve a couple transactions, like that kind of stuff. And while it would be great to just have loads and loads of excess inventory, the truth of the matter is, if you've got overstated inventory, that means you have overstated profit. That means that some of the costs that you should have been recognizing haven't been recognized. And ultimately, from the perspective of a tax conversation, that means you're paying higher taxes. And so you really want that inventory balance to be truly reflective of what's on hand. And like Jay alluded to, that one area that people may not think about that much are those lost or damaged or returns that you're not going to be able to send back out. Things that are too old now because they're version 1 of your version 3 product here. You're just never going to be able to sell those. It's time to just write those off and get them out of the warehouse. And Jay, we talk about that a lot from 600 days worth of stock. But we mentioned in the cash flow conversation that we were having a couple weeks ago, like, the one thing that you don't think about when you have that much inventory, that much excess inventory, is that you're also paying somebody to hold it. You're going to pay you're going to pay like a stocking fee or a holding fee, and especially over the past couple of months, that stocking fee has increased as Amazon's trying to get all their stuff through the warehouses, right?
Exactly.
So you don't want to you want to just get rid of that inventory. If you need to take it back, if you need to throw it in the trash, unfortunately, liquidating it is the best thing to do right now, right? This is your last opportunity before the end of the year that you can get rid of it. And if you just are not going to be in a position where you can, again, maybe that's version 1 of your now third or fourth generation product, or if it's lost, just gone, not even there anymore. It's time to just write them off. It is good for you to get that inventory level accurate.
And you say write it off, and it's this time of year. So many businesses come to us and say, "Well, I'm going to donate it, so I can write it off and then take a deduction, right?" Well, no, you can't. You can't double dip. You have to write it off, and then what you do is the easiest way is to create an invoice and sell it, and then write off the invoice. That way, you are claiming the sale and also writing it off and getting it. That's how you claim your deduction. So you can't just write that inventory off and then give it away and then claim a second expense on that. That's double dipping, and the IRS does not look favorable to that.
That's right.
So, yes.
Yeah. So again, so step one, inventory and cost of sales reality check. Do it. Make sure that you're doing it. Make sure that you've talked to those your third parties, to Amazon to validate the inventory that you have on hand there. And then mirror that with your inventory management system. You want those two to agree. That is a very, very,
Yep.
very important step as we get to the end of the year. The next thing that the next actionable piece of advice here, right, is that you want to make sure that your expenses are properly classified. So expense classification, which helps with margin clarity. We've talked and talked and talked about how landed costs are so important, and so you want to make sure that you are separating and segregating true product costs from operating expenses. You want to make sure that ad spend and merchant fees and the shipping that's for outbound and fulfillment and all of those different costs are all mapped correctly. That helps you to be able to understand both like the operations of your business more broadly, of how your business is working and where you're spending your money. But it also makes sure that you don't have just one cost of sales line where everything is kind of all jumbled together and you don't really know what's what, right? Those miscellaneous types of expenses that if you just lump them into cost of sales, that destroys your margin visibility. It helps you to, or it doesn't help you. It like hinders the ability to be able to make good decisions with the information that you have. And so those
So, I have a question for you based on just what you said there. I have e-commerce owners coming to me all the time. I want my ad spend and I want my fees all in COGS.
yeah,
I mean, it's not. I mean, it's the cost of sales, but it's not the cost of your goods. So,
right.
what I do in that situation is I will create a second P&L for them to have what they want. But that's not what we look at.
Yeah,
We analyze. We analyze the cost of goods based on the product cost, not
yeah.
based on all the other ancillary costs that are cost of doing that business.
Yeah, and I think Stephen Brown may talk about that same exact set of information that you're looking at as instead of your profit margin, right, which is that true product cost related to revenue.
Yeah.
This is more of your contribution margin, where all of those
Right.
costs are really important in evaluating the profitability and success of your business. And so it really is important to make sure that you understand what they are and that they're properly segregated. But if you're looking at product viability and profitability at a product level, like they're important things to understand, uh, but they don't always necessarily go hand in hand, like with your gap basis cost of sales.
Right.
And certainly when you think about states here, like in Texas, when you're doing tax planning, right? That cost of sales number is one that impacts your margin tax like pretty directly. And so you do want to make sure that that's accurate so that you are reporting properly. Um, uh, the the poor classification there, right? If you're just dumping everything into cost of sales, it really does limit both your operational decision making because you don't know where the problems are.
Yeah.
And so that's why it is so important to take all of those specific things, right? Not just some Amazon fees, right? Like you need to understand this is the Amazon fulfillment charge, and this is Amazon's ads, and this is Amazon's uh, shipping or whatever their warehousing
Right.
costs, right? All of the you need to break those things out separately so that you understand like where it is that that your costs are coming from. The reason why that becomes a good decision making item, right, is because that helps you to evaluate like what 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 your other activities are, right? If you look at your outside activities as well, you can start to compare those, right? When you're selling directly or fulfilling directly through your own store, that helps you to gauge like how competitive your own fulfillment charges are. It helps you to understand the return on those spends, particularly product placement, the PPC stuff with Amazon. Like it can be really important to understand like how valuable that actually ends up being for your products and the sales that go along with them. And so that can be really, really, really important. Um, so you do need to make sure that you've looked through your expense classifications so that you do have margin clarity, so that you can make both operational and tax decisions appropriately. And then our third to-do item here, our third actionable piece of activity, um, is you want to make sure that your core reconciliations are completed. Now, this may seem like a super basic thing, right? And if you're working with a team like ours here at High Rock, these things are happening behind the scenes where you don't even have to think about it. But your bank and credit card reconciliations, you need those to be up to date. And Jay, I'm not gonna beat this point home, but why might that be?
Yeah, this is the no shortcuts section. You don't take shortcuts with this. You have to look at your bank reconciliation because, there are. How many times have you gone into an account and found something duplicated and it's sitting there, right? And the only way to really see it is by looking at the reconciliation. And you'll notice that you have one item that's unreconciled and you search for that amount. Oh, there it is right there, coded to the same thing 4 days before. Or it came through and the bill came through 5 days later and then you marked it as paid. So it's like, these things happen. It's very easy to happen. But by
Right.
paying attention to it, you could actually pick up on these things and fix it really quickly. And that ensures that your January 1st numbers, your 12/31 numbers are correct. So
Yeah,
that is the important thing.
because again, yeah, if you haven't captured those things properly, you could be missing expenses, or and importantly, you could be duplicating expenses. And so when Jay's talking about those types of things that are sitting in reconciliations twice, um, that's a duplication of expense, and that means that you're going to end up with a problem come tax time. And it's
Yeah.
not just banks and credit cards that you need to reconcile. You also need to make sure that you're looking at the payment processors because it's very, very likely, I mean, it's 100% likely, that if you're selling through Shopify, if you're selling through Amazon, at the end of the year, you have some kind of receivable. Like you have income that you for products you've sold that you have not gotten that money for yet. So you definitely want to make sure that those sales channels are fully reconciled, and that all of that activity, that everything that's happened is actually taken care of and captured now. Because like Jay mentioned, if it's already messy, if there's just a hot mess going on in there, there's just no way to make good decisions for tax planning purposes because you just don't know what's actually true. And then an important thing to note too, right, is if you're a smaller e-commerce brand and you're trying to like do this on the fly and you're like, I still got cash, I'm in good shape, it's gonna be fine, I'm not that worried about it. I would say that that's not the best way to look at it because those year-end cleanups are going to be costly and more expensive later, and less effective because you're already going to miss the opportunity. Like if
Yeah.
you come back in February or in early March, right before you got to get your 1065 off or whatever, right? Like if you're in those types of situations where you're cleaning up at that point in time, you don't. There's nothing you can do. You cannot make any strategic decisions at that point in time for that tax year. It's already finished.
Wait,
And so that's why it's important to stay up to date to make sure that you have all of those things captured.
And you mentioned that 1065 or that 1120S. So if you have a pass through, that tax is due on March 15th. And if it
Yeah.
gets filed on March 15th and you uncover you had too many expenses in the prior year in, let's say, April 15th, now you're looking at having not only fixing the books, but having to amend your tax return. And that's going to be even costlier because if it's a pass through, not only do you have to do the business, you might have to do your personal again as well and amend that because the K1s are wrong. So it's really, really important to hone in on proper data recording, hygiene, and reconciliation in the current
So
year.
important.
Yes.
And that's what all these steps really are focused on, right? Like if we boiled it all down, it's hey, clean up your data at the end of the year. Make sure your inventory is good. Make sure your expenses are in the right place. Make sure that your bank accounts are all reconciled. Like those are very easy action items, and they're very much things that companies like High Rock can. That's what we specialize in, making sure that you're ready to do. And we do that so that we can help you with the next set of stuff, which are those year-end tax moves that actually matter. And now I want to be super, super, super clear here, right? Like, there's not some magic tax hack, right? You're not going to be able to buy in necessarily to like the super energy discount thing or something like this, right? But a few intentional decisions, they'll often outperform a long deduction list. So let's talk about some of those year-end tax moves that really can be powerful. Um, the first one, Jay, is the timing of income and expenses. And so oftentimes, and this is definitely a thing that I see in a lot of practices, right? If you have a little bit of extra profit, accelerating expenses can make a whole lot of sense, right? If you know that this year was a little bit more successful than maybe you were planning for, maybe you can pay the rent a month early, or
But in what situation does that make sense?
um, well, you tell me, Jay. Like when your returns are based on that same set of data, right? When you've got those
Yes.
cash-based returns.
When your
Um,
return is set on the cash basis, because if you're on the accrual basis, you're matching it. It's gonna line up every time. But if you're on cash basis and you have $10,000 sitting in the bank, and your rent is due on January 1st, take that deduction the prior year. Go ahead and pay that ahead of time. If you have, let's say not payroll taxes, property taxes, get those paid in the current year and double up on them. That way you got it covered. Do things that make sense like that.
Right. Well, and when you say make sense, it's not just like strategic sense. It's also cash flow sense. So if you have $10,000 in the bank and your rent's $10,000 and you're like, well, let me accelerate that. That may not be the right decision if you've got another payroll to make or some of those types of things, right? There's no sense in putting yourself in a cash crunch just to pick up an extra deduction.
For sure.
So it's very similar to accelerating expenses. There is, if you are on a cash basis, you may delay some income. That is a realistic strategy. Sometimes it can occasionally be a little bit risky, but it definitely can be valuable for you if you're on a tax basis. Jay, if you think about like delaying income for cash basis taxpayers, what's that even look like?
Really, the only thing I can think of is not going to the post office box to pick up your mail, because if the check is in your desk, it should be in the bank and you have it.
Right.
So
Yeah.
you've received it, you should record it. So if you are in that mode, don't check your mail. Just don't check it. That way, that's one thing. But maybe strategically, some customers are kind of doing the same thing, except they're not paying you on time because they don't have the funds. It's like, okay, don't push them and things like that. Say, you know what, I'll extend your terms 15 days and pay us in January. So there are ways of doing it, and being a good vendor supplier that way. But
Sure.
yeah.
Yeah. One other thing to think about as you get into the end of the year is owner pay and the related distributions. Obviously, you definitely, if you are filing that 1120X, that means that you still need to have reasonable compensation. So for an S-Corp, you definitely need to make sure that you've gotten that compensation to yourself somehow by the end of the year. There obviously you want to make sure that you're balancing salary and distributions and also cash reserves, right? Like you need to be thoughtful of all of those different things. But those are definitely things that you can look at. The one thing to be really, really cautious about, though, is that unplanned year-end distributions can often create surprise tax bills. So be really thoughtful about what you're doing with your money, getting it to yourself, because you don't want to create a tax surprise. And then just as we mentioned before, right, your pay strategy should align with your cash flow and tax exposure. Like you don't want to just pay yourself to pay yourself. You want it to be a very reasonable and thoughtful exercise. And Jay, when you think about pay and distributions, go ahead.
Yeah, let's jump back to those distributions. So this is something that you guys hear from me all the time in December. Check for the basis of the S-Corp and partnership owners, because if they take distributions in excess of basis, that is now a capital gain, and it is a taxable event. So, just make sure if you're running your business, you haven't taken too many distributions, because if you do, you will get that surprise tax bill come April 15th because you've exceeded your basis. And your basis is basically what your carrying value is in your stock. You put in, let's quick numbers, you put in $100,000 into the business, you start day one with $100,000 of basis. You lose $100,000 the first year, you now have zero basis. So think about it that way. Now, next year is a great year. You make $500,000, $500,000 worth of basis. But if you take, let's say, $400,000 in distributions, that reduces your basis. You're down to $100,000. So it's simple math, but there are a lot of moving pieces there. So you got to really be careful.
Yep, absolutely. One other thing to be careful about is one that we've already kind of talked about a little bit, and that's inventory write-downs. That's another year-end tax strategy you can do. But it is important that those write-downs match operational reality. And so again, you're not just writing down inventory or costing out inventory to cost it out. You're writing it down because it's lost, because it's damaged, because you can't use it anymore, because you can't sell it anymore. It needs to make sure, it needs to match up and align with the operations of the business. Cleared sales, right? They alone don't justify write-downs. Just because you're selling the product cheaply or on discount doesn't mean you can just write off all the product. It doesn't work that way. And you need to be really careful because of emotional decision making. Again, if you're making decisions based on some cash stress or things like that, they can create tax and margin problems, right? So if you're just running discounts because you want to see some cash in the bank, that can be extremely problematic. And so Jay, you'd be better to talk about this, I think, but it is important that proper documentation and reasoning matters with these inventory write-downs. What's the IRS think about this, Jay?
Well, consistency is the key to everything. Treat it the same way every time. I've dealt with this in many different lives in my career. Whether as running a Siemens operation where the entire balance sheet was immaterial, and having to write off inventory at that point, and actually having an inventory reserve at that point. You had to justify your reserve. Well, it's the same as last year. Oh, okay, perfect. That's all you got to do. So be consistent with what you're doing, and if something is damaged, write it off. If it's impaired, write it off. Now remember, your inventory should be carried at the lower of cost, what you paid for it, or the market value, which is what you sell it for. So if the value of your inventory is carried at $50, but you can only sell it for $35, well, you should be marking that down to $35. And at that point, get it out of your warehouse, because it's just a drag at that point. So, and remember, donation is always good, but don't double dip.
Absolutely. One other area that's really important, and it's kind of funny because I noticed this at the bowling alley every year end, is capital expenditure, equipment, warehousing improvements, technology improvements, maybe new TVs for your bowling alley, maybe a nice new carpet, something like that. That's improving the user experience, right?
Parking lot full of G-Wagons?
Yeah, maybe not that, but those types of things that are truly like helping and supporting your business. If it helps operations and you've got the cash to do it, like, it may make sense to do some type of capital expenditure, but it's absolutely something that you should consider. Importantly, just like with everything else, right? Like, don't just spend the money to reduce taxes at the expense of your cash stability, right? It doesn't make sense to use all of your capital to buy some kind of equipment if you're not going to be able to fund it or use it properly because you don't have the right cash to make it work. And so it is really important that you're really thoughtful and strategic around the decisions that you make around capital expenditures, especially around the year.
So,
Jay, any thoughts there?
Yeah, the one thing I'd like to point out there is yeah, you spend $100,000 upgrading your facility or putting in carpet and TVs, and you have to pay out 100K for that, or you get a loan for 100K. You're at some point you're going to pay that. The tax benefit that you get from that,
Yeah.
20,
30%.
21,000, 30,000,
Yeah.
depending on how you're taxed. So it doesn't equate dollar for dollar in tax savings. So
Right.
keep
It's
that in mind.
yeah. It's the Schitt's Creek joke of well, what are you
It's a
gonna do? Just
deduction.
write it off? Right. What does that even mean? Like, no, you can't. That's not how it works, right? You had to buy it,
Yeah.
and you only get the tax advantage of it. It's not a dollar for dollar, right? You're not getting the entirety of whatever capital expenditure you got back in tax relief. That's not.
Yeah.
That isn't how it works. And so again, that's why it is so important to make sure that it's strategically aligning with whatever your operations are. Uh, yeah, like at the bowling alley. Again, if your carpet's a little old, it's a good time of year to get some new carpet, right? Or if it's a little bit dark in the bowling alley, right? Getting a couple TVs to help lighten it up, really valuable thing, right? And it's not just it isn't just a tax consideration; it's also an improvement of the business more broadly. And
Yeah.
so that's really that's really what you should be thinking about, not just the acceleration of some deductions, like Jay
Yeah,
was talking about.
for sure. And when you're scrolling on TikTok mindlessly and that tax advice comes on, scroll past it.
Please.
Actually, better yet, put your phone down. Actually, don't put your phone down. Just call your CPA or your tax preparer and say, hey, what do I need to do? And that will be the best advice you get at that point. Don't take the TikTok advice because a lot of it is not from authoritative sources.
Yeah, right. The last thing that I want to touch on here, right? Everybody, you see this happen a lot, especially with sole proprietors or owners in businesses, right? You want to make sure that you are maximizing your retirement contributions if you can, and this is the time to do it. But that should be a high level consideration only, and it's not a thing again that you should be doing at the last minute. This is a thing that you should have been planning for all year. So that you're not just making retirement funding contributions to at the expense of being able to make payroll or something like that, right? That these are long-term planning things that definitely should be considered that way, and definitely be like last-minute moves. Jay, any final tax strategies that you want to talk about before we move on?
The only thing I want to say is talking like these contributions. Talk to your financial advisor. You should be talking to them in December either. You should be talking to them throughout the year and having these same conversations you're having with us when we're talking this planning. Because, there are a number of retirement and investment vehicles that are tax advantageous. And those are the conversations you need to have in April for this coming year, not for the past year. So think about that, and that's just being prepared and having things lined up so that you hit 12/31. It's just another day. It's another day where you're going to go out and stay up late, have a good time, and watch bowl games the next day. Not a day you're going to stress out about your taxes.
That's right. And one thing that you can do to help you with that in 2026 is shifting your mind in 2026 to start doing that planning at the beginning of the year, right? Year-end tax planning is just a checkpoint, right? If you've developed a really good tax plan, you started that in quarter one. That's where you built the structure. That's where you built the strategy around this, right? That's when you made the election that you're going to maximize your 401k contributions this year, right? Like you did that all in quarter one. And so year-end tax planning is a checkpoint in the strategy building. It's not the solution. Right? Those things that we talked about aren't the end of the rope. They're the beginning of the rope, or the beginning of 2026's rope. And so so I'll reference back to some of the things that we talked on previous shows about, right? Some key things that you need to do in quarter one so that you can set yourself up for success, right? You need to create a simple 12-month cash and tax forecast. Like we talked about cash flow forecasting and using a 13-week model. You can do this as part of a budgeting process, or engage somebody like Hyrock to help you to support helping you get this tax model together and cash model together for the year. You also want to review your margins, your cost of sales, and your ad efficiency at least quarterly and probably more frequently. You don't want to just be doing that at the end of the year when you're getting the final steps. And like we mentioned, like explicitly on a previous show, you need to establish a consistent financial review cadence. You should be meeting with an advisor once a month to talk through what's going on, what's the right things to be doing next, right? Tax planning, business planning, strategic decision making, it all happens throughout the year, not just in December. So make sure that you're that proactive brand that plans distributions, that plans inventory buys, that plans hiring with clarity, that does all of those things with good strategy, with clean data, and all the information that goes along with that. Don't be the reactive brand that gets surprised by that April tax bill because you triple counted expenses in your unreconciled bank account, right? Don't be that guy. Be proactive, be well planned, and be strategic. Jay, if you think about Q1 and transitioning Q1, any other thoughts that you want to add there?
We make the plan. We implement the plan. The plan goes off the rails. We rewrite the plan. That's it, And when I say goes off the rails, your revenue could go skyrocketing up, and you now have a profit problem, and so now your plan is completely wrong. So take that budget that you created based on what you thought you were going to do, and then, like Chris said, build a 12-month cash and tax forecast. Well, you're going to keep updating that forecast. Every month, we're going to get closer and closer to December. We're going to look at those numbers, and we're going to update that forecast. And we're going to use that to do our planning. And that's how we're going to know what you're going to have to pay come April. So accept that the plan is going to go off the rails, because it always does. Could be good, could be bad. But in essence, accept it, don't panic, and just create the new plan. And that's what it's all about. Yeah.
Absolutely. And so if we summarize this our episode today, clean numbers are the most important piece to effective tax strategy. That comes in monitoring inventory. It comes in making sure your expenses are in the right place. It comes in making sure your bank accounts are reconciled. Fewer, smarter tax moves beat random deductions. So being strategic around the way that you're planning is way, way more powerful than just trying to find a bunch of deductions at the end of the year. And quarter one planning is where you set that plan that Jay just described, where that you can then execute and respond to in a strategic way throughout the rest of the year, so that when it comes to December of 2026, you already know what to expect, and you don't have the stress of what am I going to do with respect to taxes.
Yep.
And so, Jay, any other final thoughts before we get out of here today?
I just want to say, use these last few weeks and start planning. At this point, clean some things up, but start planning 2026 and get that plan moving. And it's times like these when you can look back at the year and say, hey, we did these things right, and you know what, I wish I did these other 3 things better. And you make that plan moving forward to do that, and you implement that, and you talk to your team, and you build processes and SOPs, and you just dive into it in the new year. And you know what? You're going to achieve what you've been trying to do, because you're paying attention to it. You're tracking it. You're measuring it. When you measure it and tracking it, you can change it and adjust it, and that's what it's about. Yeah. So yeah, that's it.
Yeah, and I think that's a great way to end. Jay, I know we went a little long. We talked about some conversations here, but I don't think they're necessary today. So thanks everybody for spending some time with us this afternoon on the Rocks. I'm Chris. He's Jay, and we'll see you in the next one. Have a good one.
See everybody.